Welcome to Real Estate Radio with your host, Ken Sax. This show is created for you, the consumer. Our goal is to empower you with information and education, thereby giving you the tools needed to make informed decisions when it comes to real estate. Real Estate Radio is brought to you in part by the Spokane Association of Realtors. Now, here's your host, Ken Sax.
Well, welcome once again. I am your host, Ken Sax, and this is Real Estate Radio with Ken Sax. And today we have a lender in the house. We have Drew Henry with Movement Mortgage, and the purpose of today's show is to give you insight and knowledge that you may not have when it comes to the lending and mortgage process and essentially getting a loan. We're all about, buying homes, selling homes, and in buying a home, oftentimes it involves a loan. But what do we really know about that? So again, today's guest, Drew Henry with Movement Mortgage. Drew, hello.
Hey, how's it going?
It's going well. Thank you for being here. Why don't you go ahead and tell us a little bit about yourself?
Yeah, so I'm the branch manager for Movement Mortgage here in Spokane, just out of downtown here. Movement Mortgage, we're really an innovative company in the mortgage world, so really progressive thinking. Started in 2008, we're now the 7th biggest lender in the United States. So really excited about where the business is going and where our company's going as well.
Good. Well, let's start off. Give us kind of an idea. What's the market like today?
Yeah, so what always gets asked, right, is where rates at. And
right.
Looked into it this morning in terms of where we're sitting at this very second. And say you're doing a conventional loan today. You want to get locked in. 4.375 is really your average rate as we sit today. But there's a lot of different factors that have to do with where that rate ends up, right?
Sure, because I would imagine, Drew, in your business, you'll get folks that say, for example, 4.375. Well, I got quoted 4.175. Why am I able to get a lower rate here versus with you?
Well, the first thing is, what you get quoted and what you end up with are two different things, right? So until you're actually locked in on an interest rate, nothing's final. Keep in mind, too, once you do lock an interest rate, you're not locking the rate, you're locking the day's rates. So that can change, whether you want to buy down your rate, which maybe we'll get into, or you want to lender credit back, that can change. But a couple things, your credit score is huge. Where your credit score falls in line, you're going to have credit hits for that. And loan to value, how much money are you putting down? That's going to be a big factor. But every lender charges different fees, different origination fees. So you really need to dissect lender to lender. What's your underwriting fee? Are they charging you $1,000 or 1%? Because that can vary drastically.
So are you saying that it may not be apples for apples like I think I'm getting as a consumer, where lender A quotes one rate, lender B quotes another rate, but what I'm hearing, Drew, is that the lender B who gave me a lower rate, they may be making up for that somewhere else that I don't necessarily realize. And so then I select lender B and, when push comes to shove, I'm paying money in other areas that I didn't necessarily think I was incurring.
Yeah, it's not all about interest rate. Interest rate's great, but we get down to an origination fee. Let's say it's a $300,000 house and they're charging you 1%. They're giving you a better rate, but they're charging you $3,000 on a $300,000 house just to do the loan. Whereas maybe lender A has 1/8 of a percentage higher on interest rate, but they're only charging you $1,000. So at the end of the day, which one is the better value?
So as a consumer, what can I ask? What do I need to know? I need help because I don't understand all these origination fees, interest rates, underwriting fees. It sounds like there's fees. So what can I do? What do I need to know as a consumer where I can lay it out and do a fair comparison and really understand what I'm paying for and what I'm getting? Is there help for me?
Yeah, so after the mortgage meltdown at 08, 09,
I remember that.
A lot of the disclosures changed, and what has to be disclosed now is what your APR is. Well, APR, people say, oh, that's the interest rate. Not true. You've got your interest rate, and then you've got your APR in the mortgage world. So APR is interest rate plus any fees amortized over 30 years. So they're going to add in those fees to get you a true interest rate over 30 years. So if you're looking at a loan estimate from 2 lenders, you can look at that APR and see really what's going to be the better bang for my buck over that 30, maybe 15-year term.
So that would account the APR, and what does that stand for?
Your associated principal rate.
Okay, so that would account for these fees that I may not be aware of. So to just simplify it and land the plane as a consumer, instead of saying, hey, what rate am I paying? Hey, what's my APR?
Correct, but you get confused because you go to a car dealership and APR is interest rate. APR in the mortgage world includes interest rate, includes your underwriting fee, includes any other fees so that the lender can't. That's what happened is lenders said, oh, I'll charge you a 3.5% interest rate, but charge you a $5,000 fee. And consumers weren't being educated on this. So this is to protect the consumer. So yeah, boil down to that APR, see what they're charging you there, and apples to apples, that's going to be the easiest way to compare it.
That makes it easy. So we should be shopping APRs.
We should be.
Gosh, okay, good. So we talked about one's credit score. What determines one's rate? If you and I both go and apply for a loan to buy, let's say your example, a $300,000 house, what is going to go into determining the rate I'm going to be quoted versus the rate you're going to be quoted?
Yeah, so what we look at is, we whether you're at a 5% interest rate or a 3.5% interest rate, like I mentioned, you lock into a table, you don't lock into a rate.
Okay.
So what they call it is ending par. So if you end par on a loan, that means you're not paying any points and you're not getting any sort of lender credit back to maybe, pay off some closing costs, say. We'll get into like some rate buy downs, but credit's a huge deal. 740 and above is what's considered A tier credit now. If you have a 740 and above and you're putting over 40% down, you're not going to get any sort of hits on your interest rate. So even though today we're sitting 4.375, that's the average rate. Mm-hmm. Well, if you're not above a 740, you might have a hit that takes that up to 4.5%. If you're not putting 40% down, maybe we're now up into the upper 4s. So just because you see rates as low as, that doesn't mean that you're going to get it.
You're going to get it.
Right?
Gotcha. So credit score. So credit score sounds like it's a pretty important number and that it can help me or hurt me. So this kind of leads me to the question, when should I start talking to you as a lender versus, I guess, when do most people start talking to you?
Yeah, I think a lot of people think in the real estate world that I'm going to talk to a realtor first.
Right.
And I'm going to go look at homes, and then once I find the home I want, we'll go get approved.
Exactly.
But that's not the case, right? Most realtors shouldn't be opening doors before someone's pre-approved, not letting someone into a seller's house who isn't well qualified. What we get a lot of is, it's great that you want to come get pre-approved right before you go look at homes. But when it comes to credit score, maybe there's some things we can do over the short term to get that score up that can save you a ton of money in the long term with interest rates.
Short term or even long term, if I know that we're going to be buying in 12 to 18 months, is there a benefit to talk to you now to where you may be able to coach us on what to do over the next 12 to 18 months to improve our credit score to the highest number possible?
Yeah.
I mean, that's a really good strategy, but I don't think a lot of people think that way or are informed with that.
Well, we've gotten stuck in this world of credit simulators from your credit card companies. There's some companies out there that shoot you a monthly credit score. So we think as consumers, and we've all been guilty of this, that we think that's our true credit score, and maybe we're using that to coach ourselves how to improve our credit scores. You want to apply as early as possible, working with a mortgage professional who can really dissect that credit report, because what we pull is going to be way different than what one of these big companies online pulls, who does really a snapshot, because the weight on a mortgage people don't understand credit scores are different for everything. They're different for mortgages, buying a car, versus really a snapshot that your credit card company might give you. So when we get a credit report, it's a true mortgage report card. It's weighted the way that it's going to be looked at by an underwriter. And then, a lot of times we can look at it and say, maybe if you pay down this balance to this amount, maybe we get this taken out of collections and get it put as paid. We can get those scores up 30, 40, 50 points over a span of maybe 30 to 60 days.
And if we can get the score up 30, 40, 50 points, meaning credit score, and the impact that would have on our interest rate, I'm getting away from producer Kent to roll into our first break. But when we come back, I really want to drive that point home, because this, in my opinion, is one of the biggest things that buyers miss. They miss this huge opportunity. And when you're taking out a 30-year, a 360-month payment that you're doing 360 times, that's kind of a big deal when you're paying it every month. So stay tuned. We are rolling into our 1-minute break. Real Estate Radio with Ken Sax, my guest, Drew Henry with Movement Mortgage, and we'll be right back.
Is your child having trouble coping with a personal disability, but don't know where to go? Consider our friends at Breakthrough Incorporated. Breakthrough takes great pride in mentoring their DDA clients who have intellectual disabilities and their BRS clients who have challenging behaviors toward the creation of safe, appropriate, ethically sound life goals. They integrate programs at school and home to enrich their lives. They work hard to make a positive difference in you and your family's lives. Breakthrough provides a highly structured, fully staffed residential setting in local neighborhoods. 6 in Spokane and 2 in the Tri-Cities. Diagnoses affect people differently, so their service to each resident is unique, giving them the opportunity to grow and evolve. For more information on Breakthrough, visit their website at breakthroughincorporated.org.
Hi, this is Kurt Stockwell with Well Dressed Walrus. We are a local website design and development company here in Spokane. What we do is build beautiful, usable websites for local businesses. A website needs to be beautiful, it needs to be usable for your users, your customers, and yourself. Contact us anytime. We'd love to talk with you about your online marketing.
What? You haven't been to the library lately? Stop in today and see that the library is more than books. Spokane County Library District facilities feature on-site technology, including Wi-Fi, computers, and printers, as well as free use of meeting rooms. The Library District offers events and programs for all ages, from story times to career development and employer classes to Social Security workshops. Our staff is well trained and happy to help. Find out more about your library at scld.org.
And welcome back. My name is Ken Sax again. You are listening to Real Estate Radio, and my guest, Drew Henry with Movement Mortgage. Where we left off before the break, we were talking about credit scores, the impact credit scores has on your interest rate, and why you want to talk to a lender as soon as you can when you know you're going to be buying a house. Even if it's 12 months, 18 months out, that just gives you more time to do things that someone like Drew will tell you to do and will coach you to do, so that you end up with the highest credit score, so that when you're ready to push the button to get a loan, you have the best possible interest rate you can get. And, to land the plane, that could be the difference of, say $50 a month or more if I do the things that I'm told to do so that my score is as high as it can be. And when I say $50 a month, you're paying that every month. And you're paying that needlessly simply because you did not speak with a lender as soon as you knew you're going to be buying a house. So that's an important point. And again, I've been in real estate for 25 years. That's one of the biggest mistakes I see people make. So that's a huge takeaway in my mind. The other huge takeaway, Drew, was how we started off, shopping APRs.
Yeah.
versus interest rates.
Getting to what you're saying, getting that annual percentage rate down as much as possible. Like we talked about apples to apples.
Right.
But you trying to get that APR down for yourself, even if you're not shopping compared to where your score is at. Maybe you're at a 650 compared to getting it to a 700. How much can we get that APR down?
Sure.
And to hammer home what you said, it's really exciting that we live in a world now where the curtains have really been peeled back from the mortgage industry. A lot of those unknowns that happened in the early 2000s, they're gone. Transparency is really the name of the game now. And getting in touch with someone who can coach you through that. A lot of people, I was raised to think that you still have to put 20% down to get a mortgage.
Right.
And that's not the case anymore. So maybe there's a program that you don't even know about that Google didn't tell you that maybe your mortgage professional can coach you through, get your interest rate down, your annual percentage rate down, so we can get I had a client, I'll just tell you that we got their score up 100 points over a span of 90 days. And what's that do to their APR? How much money does that save you over 30 years?
Sure.
And so we get so focused on, the really small, oh, they quoted me this, you quoted me that. It's just like finding the right realtor. You got to go out, hire the right mortgage professional who's the right fit for you, who's going to go work for you. And once you find that fit, let them go to work.
Sure.
Because, we are paid today to really have your best interests at hand.
Good. And I know we want to get into rate buydowns. And rate buydowns is talking about something that people don't understand, underutilized. And let's start with the basic. Folks, are you qualified on the purchase price, or are you qualified on your monthly payment when buying a house?
Let's break that down. What you're qualified off of the payment. You're not qualified off the purchase price first. But what does that mean? You hear principal and interest, but is that all that goes into a mortgage payment? No. You're going to have taxes included. Your homeowner's insurance is going to be included in that. And then mortgage insurance, which is still there today, right? If you don't put 20% down, you've got to have private mortgage insurance. We were talking this morning about FHA. If you do an FHA loan and you don't put 20% down, you have mortgage insurance as long as you have that
Doesn't
FHA.
go away.
Never goes away. Now, on a conventional loan, it has to go away once the loan to value hits 78%. You can request for it to go away at 80. They're not going to knock on your door and see if you want to have it dropped off.
Right.
But on a conforming conventional loan, it has to go away at 78%. So we got principal, we got interest, mortgage insurance. Say that comes out to $1,000 a month. You're qualified on a $1,000 payment, not on a $200,000 loan, because we don't know what you want to put down. We don't know all those factors.
Right. And where this comes into play in rate buydowns, let's say the buyer and seller are stuck. And they're stuck, say, buyer's going to pay max $290 and seller's not going to sell it less than $300,000. So typically what people do is they start negotiating somewhere between that $290, $300. And I always say stop, because let's just say the seller's like, okay, I'll sell for $290. But what's the payment on that $290,000 price that the buyer has? So if we can do something to maintain that payment, but let's say we appease the seller and on paper we're selling, let's say the house sells for $300,000, but buyer has kept his payment that was consistent with the house being $290,000. Isn't that a win?
Yep.
And that's the magic of a rate buydown.
Exactly.
Now, can you explain that better than I just did?
That's something that you can definitely utilize. One thing that I'll say about that is all we care about, all an underwriter cares about, is your debt-to-income ratio.
Okay.
That's it. And that changes program to program. But as long as we can keep your debt-to-income ratio in line with the Fannie Mae limits or Freddie, whatever we're using, we're fine with that. Now, what you can do is, like, say today we said average rate's 4.375. Say you wanted to get down to a 4% rate. Well, you hear the term points all the time. You're paying points. What does that mean? Well, a point, in layman's terms, is you're paying 1% of the amount financed. So average home price at $200,000, what's a point? That'd be $2,000. So based off today's rates, you could pay $2,000 to get your rate down from 4.375 to 4%. Now, Would that qualify you for Morehouse? Sure. Now, what you're asking is there's a $10,000. We're looking at the opposite here. There's a $10,000 difference between buyer and seller.
Right.
What are some ways we can get creative to bridge that gap? Well, you can buy your rate down, but on the opposite side, you can do what's called a lender credit, where you can take a higher interest rate and have a credit coming back from the lender. So same way around, say you want to go from a 4% interest rate to a 4.375 interest rate today, that $2,000 could be applied to that 190 figure you use.
Yep.
And you could take that little bit higher interest rate.
Sure. Or taking the direction I was going, if the 4.375 at that payment, but the seller wants more money for the house. Well, let's say instead of coming down $10,000 and the seller losing that in net proceeds, if we can apply, say, $2,000 to lower the interest rate, and that gives me a payment consistent with, as a buyer, what I would have paid on a 290 house.
Yep.
So the seller now is just contributing $2,000 instead of $10,000. So they've preserved $8,000 in net proceeds. Buyer now has a lower rate, which gives them that payment consistent with a 290 house. That's the magic of a rate buy down, and that I never hear people talking about that. Like, they don't even know that exists. They get caught up in, well, I'll meet you halfway. Well, how about I'll contribute $3? Well, I'll come up $3. Stop. Talk to a lender. Is there an opportunity for a rate buy down? To me, rate buy downs are magic.
Yep.
They're just magical. So that was a lot, but I think you can come back and listen to the show again. We almost need a whiteboard here, but that's rate buy downs. So, and I know we're running out of time. First-time home buyer, you had a lot to say about a first-time home buyer. What the heck does that even mean? What's a first-time home buyer?
Well, walking down the street, you think it means you never bought a home before. That's
right.
Not the case.
First time.
If you haven't owned a home in the last 3 years, congratulations, you're considered a first-time home buyer.
The last 3 years.
Last 3 years.
And what I think of is, we're out. We had a recession not too long ago, and we had a lot of distressed sellers, short sales, foreclosures. Those folks then did not own. They've been renting.
Yep.
So guess what? If you're in that situation and it's been over 3 years, which for most of those folks it has been, you're a first-time home buyer.
Yeah, and if you have two borrowers and one of the borrowers hasn't had their name on the property in the last 3 years, you're still can go through a first-time home buyer program. What does that mean? What's a first-time home buyer program? There are, for example, we have what's called the MAP program. It's a movement assistance program where we take a 97% conventional Fannie Mae loan and we pair it with up to a 3% grant from Movement Mortgage. It's a non-repayable. It gets treated as a gift that comes to closing, that we are literally gifting you those funds. Those are the programs that are available here in 2017 that weren't around when I bought my first house.
Right.
That wasn't the whole 20% down you had to come with. That was really the token forever. So those sort of programs are available, and you're not even paying that much higher of an interest rate to get there like you might think.
Now, so those programs, do all lenders know about those programs?
I would say no.
Okay. So to me, that almost shows us that we should talk maybe to more than one lender.
Yeah, because what lender A may have as a first-time homebuyer program could be completely different than what lender B has. Each state, for the most part, has what's called a bond program, where the state will actually give you a second mortgage for your down payment. But the way those work is that the second mortgage is due when you sell the house or at the end of the 30 years.
Mm-hmm.
So say you got a new job, had to move, and you're thinking, oh my gosh, I've got $10,000 of equity in this house, but you're forgetting about that second mortgage that has to be paid off. So those are available kind of almost nationwide to a certain degree, but a lot of the lenders have started to roll out these grant programs because it's actually better business sense for them to gift the borrowers the money than for them to take out a second mortgage.
Sure. So again, that drives the point home, because so often when I align myself with a buyer, they'll come in with, well, we're going with this lender. Well, why? Well, we've known them. We've been, they've had our checking account or whatever. We know them, for 20 years, or we did 3 3 transactions with them. I get the loyalty. I get the relationship. But now listening to you, Drew, don't you think maybe it would benefit you to, you can still, he's my number one person, but I'm going to just talk to a few others because maybe there are programs that would benefit me and my family that my number one person doesn't know about. So that's really an advantage as to why you should be talking to other lenders. And I know we're running out of time here, Producer Kent. And the one thing I always have to remind people, and I made a note of it, buyers, when you're in escrow and you're waiting to close on your house, I know you're excited. Do not go out and buy all that new furniture on credit for the house you don't own yet, or buy a new car, or quit your job, because is that going to show up prior to closing?
Yeah, we've got a credit monitoring service that will actually alert us as soon as something like that happens.
So Big Brother is watching, and what that means is you're getting ready to sign tomorrow for your new house. You're all excited, and guess what? You now don't qualify because you just put $5,000, $6,000 on your credit for that furniture for the house you don't own yet, and now you won't own. I just can't drive that one home enough.
Yeah.
Any last words as we close up here?
Yeah, last big news in the mortgage world is for 2018, the conforming limits just went up from $424,100 to $453,000 and $100, which all that means to everyone out there is that for a conventional loan next year, your amount that you can actually get financed just went up by $30,000,
wow,
which is a huge deal.
Good.
Yeah.
Folks, talk to a lender. Talk to more than one. My guest, Drew Henry with Movement Mortgage. For more information on Movement Mortgage, you can go to movement.com. You want to contact Drew directly, 509-553-2221. You can call Drew directly. You've been listening to Real Estate Radio with Ken Sax, and thank you for joining us, and we'll see you next time.
Real Estate Radio is produced in Spokane, Washington by SpokaneTalksOnline.com, which is solely responsible for its content. Ask Ken a question, recommend a guest, and hear this program again online anytime at SpokaneTalksOnline.com. Real Estate Radio is brought to you in part by the Spokane Association of Realtors. We wish you a great day.